Study objective 5 actually was part of the last video regarding interest. Study objective 6 just talks about financial statement, presentation of receivables. Not a lot to that. Moving on to managing receivables. Companies take a lot of, spend a lot of time and effort deciding who to grant credit to. That is, who do you sell to on account? You can't just do it to anybody or sell stuff to anybody on account because they might not be worthy of that credit. So management will go through a lot of steps in managing their accounts receivable, deciding who to give credit to, establishing payment periods, monitoring things, so on and so forth. So this is some reading that you can look through. And then study objective 8, evaluating liquidity of receivables. Companies will do this to see if they're collecting receivables as quickly as they'd like to. A lot of times this analysis goes into a company deciding what kind of a discount to offer their customers if they pay early. So we'll look at ratios here like the receivables turnover ratio. How many times in a year does a company turn over its accounts receivable balance? And then what's the average collection period? How many days on average does it take to collect an AR? If the number is like 35, 40, 45, that's a long time. Companies might want to accelerate that. Remember, getting the cash is the most important thing. So they might want to accelerate that by offering discounts to customers. So you're probably going to have to see, we're going to work on a question or two that asks you about these ratios. Let's see what else. Accelerating cash receipts. Study objective 9. Companies will accelerate cash receipts by any number of processes, with the main goal, again, that getting the cash is the most important thing. So accepting national credit cards like Visa, that is one way for companies to get money quicker, by accepting Visa cards. In that scenario, the company, the credit card company, pays the company immediately when the customer buys something. So you go into Target, use your Visa card, $100 purchase. Visa will pay Target right away, okay, usually the same day, but they're not going to give Target the full $100. They're going to give Target like $96, $97, and they're going to then collect the $100 from the customer. So there's like a service charge that Visa charges the retailer for accepting their credit card. You can see an example of the entry right down here. Target would debit cash for $970. They would record the service charge expense for the amount that they are effectively paying Visa, and then they record the revenue of $1,000. In this case, $100 in the case that I just mentioned off the top of my head. And so this is what Target would record for Visa sales. Now, if Target had their own credit card, they do. If a customer uses a Target credit card, and Target is the financing company too, and they're the ones who go out and collect the cash from the customer, then there is no service charge expense, because they're not getting immediate payment. They're effectively still having accounts receivable because they're still waiting to get paid from the customer ultimately. So using your own name brand credit card doesn't have a result like this. That just debit AR credit sales is a typical sale on account. Using Visa gets them the cash quicker. Companies can also sell receivables to factors. Factors, basically a bank or some other institution, some other company that will buy receivables at a discount and then go collect the receivables hopefully in full and make a profit. So when you sell receivables to a factor, you get the cash. Here's an example where we had $600,000 in receivables. We get the cash, but we have this service charge expense of 2% because that was the deal when we sold the receivables. So if we get this cash right now, the factor wants to do it because they get to go collect this cash. Okay, and that, I think, is a wrap on Chapter 8.